Hi, this is Nahid again, and today is the session 4, covering the learning outcome 3 of finance for administrative managers. And this is the last session so far, and we are covering the ratio analysis and other things, and covering also the assignment briefing, including the activities for the assignments. So our learning outcomes of today is understand the structure and purpose of company accounts. Basically, we are looking for the different kinds of reasoning and purpose of main financial statements, and we will analyze company accounts, especially the income statements and the balance sheet by unit ratio analysis, and we will identify and calculate the data which is extracted from different financial statements, for example, income statements and statements of financial accounts for ratio analysis. So this is actually our last learning outcomes of our finance for administrative managers unit. And this is the core of the finance unit, and then we need to understand for how the ratio is calculated and what is the meaning and the purpose of the ratio analysis based on the different company accounts. So before I start, we need to understand actually why we produce accounts, why we need accounts, and what the main accounting statements we need to understand actually why we're producing accounts. And what's the main purpose and what's the main reason for different accounting statements, and who will use these accounts, who uses accounts, and then by these we will understand the different types of accounting. And then because these accounts will show the numbers, and the number we need to interpret that numbers, because if this is a number, if we can't interpret this, then we can't analyze or can't make any decision. So these are actually the scope of this today's session. Why producing our accounts? Basically, we want to provide the valid information on the basis of our business for the stakeholders of our users, basically internal and external users, to make economic decision, to make a business decision, and to provide a record of how a business has performed financially over the time. So we have to make a stipulated period of time, and then we need to see how the business has performed or will perform or is performing over the time. So let's see the why we're doing business. As a concept of business, we will take one hypothetical example. For example, Mr. Jack, who is the owner of a small company, and he's doing his business from his home. It's kind of, home business, and then he decides to use eBay for a new business. And Jack purchases 6 sweaters from Crosby Block wholesaler for £10 each of this sweater, and then for the 6 sweaters, total cost is £60. And he thinks he can sell them for £15. The straightway we can see that the £15 is if it is a selling price, and if the buying price is £10, then he can make a £5 profit straightway. And but we need to know how many sweaters does he need to sell to get his money back, because it's not as £15 is a selling price straight, the £5 is a profit, because there is other costs are associated, including this process. So he sells all the sweaters. So how much profit has he made? So we need to know, okay, what was the profit amount, and then does he need to sell to get his money back? How many sweaters he need to sell? But there is a cost, definitely. He incurs the cost of eBay listing cost of £12 in total, and delivery postage cost of £1.50 per sweater. So there is a cost, delivery and postage charge, and then we need to pay something to eBay for using that advertisement. And what is it there for his net profit? We need to calculate. and then would it make any difference if a customer pays in a week's time, so that like deferred time, so how it affect in his accounts. So let's see how we calculate his profit from this transaction. So he sells £15 each of these sweaters, 6 sweaters, £15, and that is the sales is £90. Cost of sale, because he bought all of these 6 sweaters, £10 each, and that's a £60. So eventually we can see that the gross profit without taking any notes of the cost, other cost of overhead or other selling expense. So that's the gross profit of £30. 90 minus 60 is equal £30. Now we can see the other overheads like postage, eBay cost. So that's the postage is £1.50 of each, and that's a £9 for 6 sweaters, and the eBay cost is £12. So that's total overhead is £21. So if we minus £21 from £30, then we will get the £9. That's the net profit, and that's the gross profit. We call the net profit is operating profit, and the gross profit is just a sales and cost. Now, there are 2 types of main accountings, like income statement and then the balance sheet. Balance sheet shows assets and liabilities position, including all capitals, investment and borrowings and everything. And income statements, we all just see the over the periods, the profit and the loss. So if the sales, for example, is £1,000, and then we need to minus the operating cost, that's the £900, and then we can see the profit is £100. That's the straightforward gross profit. But this operating profit, this gross profit, we need to have some other expenses, overheads. That's the basic of actually the calculation, sales minus operating cost, and that will give you the gross profit. But here we have some other expenses, which is overhead cost for any transaction or business or service. So main statements, basically, we use that main statements for making a statement of financial position, or it's called a balance sheet. Basically, the statements we are using for consecutive 3-4 years. So if we have a last year's statement, then we can compare it with this year, and then we can compare it for the next year. The benefit of using statement, we can use profit and loss account for our income statements to make cash flow forecast. From the previous cash flow statement, we can forecasting the cash flow, we can do the cash budget, and then we can do predicted budgets for the next 3 to 5 years, or the long-term budget. So this helps to make financial position to judge the cash flow budget, cash flow forecasting, and other things. So who actually use business accounts? So we have a number of stakeholders, and then we have a primary and secondary stakeholders, and internal and external users. Owners, the primary stakeholders, who are the business owners who need to see the profit and loss and assets and liabilities position of the firm. Definitely he or the owner or the team of the owner, or if it is the proprietorship, so he or she needs to decide what is the profit and liabilities position of his or her own firms. So need to take a managerial decision. Management needs to see the business or different kind of business for making any decision or any kind of budgetary monitor. Staff, customers, these all the primary stakeholders. But suppliers, they are the external stakeholders, but they are the secondary stakeholders, but they are also associated for the business. Competitors are the secondary, government is the secondary, pressure groups are secondary. So these are the stakeholders of the senior employees, directors, shareholders, suppliers, customers, builders, locals, local planning authority, bankers, because they are associated with the business directly and then have a contractual relationship with the stakeholders. There's also secondary stakeholders with environmental risks, local residents, local schools, local authority, and the other department who are externally associated with the business. That we call it secondary stakeholders. So all these kind of accounts are helpful to make any decision for primary and the secondary stakeholders. So now, what's the profit? So it's basically we can calculate the profit from sales, and then we can deduct the cost from the sales and can get the profit. Well, the main accounting statements, and what does it show? Basically, the main accounting statement is income statements, which is profit and loss account, and then from here we can do statement of financial position, which is called balance sheet, assets and liabilities. And then we did one example last week, that's a cash flow statement, and we did a budgeted cash flow, and then we forecast the cash flow statement. So these are actually the main accounting statements. Any stakeholder can use easily these different kinds of accounts and then make any decision from the basis of this data. And then we can understand what are the primary and secondary stakeholders based on the contractual and non-contractual obligations. Normally, the contractual obligation with the business are called the primary stakeholders, and non-contractual obligatory people are the secondary stakeholders. So we have seen one example of Jack. He bought some sweaters from the eBay, and then he sold some sweaters by postage, and then he can straight away did some profit. So if Jack decides to use eBay for a new business, and then he can sell them at 20% markup on cost. So he's thinking he will make a 20% profit on these sales, and then how many sweaters does he need to sell to get his money back? That's another profit concept. And then he sells all the sweaters so much, how much profit has he made? So let's see. He actually incurs the other cost of eBay listing of 8% of sales, because what he sold, then what is the cost of percentage? That's the 8%. And then postage cost he reduced £1.50 to £1. That's his recent postage code, and what's therefore the net profit. Let's see the income statement, profit and loss account, and then because on the profit we can make a different kind of decision, and we can kind of option what it make any difference if a customer pays in a week's time, or he gets a week credit on his supplies. So it's like, debtors and creditors time. So what will be the impact on his profit and loss accounts? So now he sold 15 sweaters, 15 poundage, and then that's the sales is £225. And then his cost of sales of each sweater is £12, so that's £180. So normally the gross profit is £45, but he has got some overhead cost, postage, and then eBay cost. That's £33 altogether, and then his operating profit is actually the £12 here. So basically, the income statements look like this. So we have got a sales and cost of sales. That's our gross profit. We can have operating profit by deduct the expenses. This is called the overhead expenses of selling. So we have got admin expenses, we have got selling expenses and depreciation. It's all together 55,000, and we deduct this from this gross profit, and then we can get the profit. This is all about before the tax. and interest. So if we have any bank loan or borrowing, so if we pay that interest, that is profits before tax. If we pay the interest, and then if we deduct the tax, the regularly, annually, that's the profit after tax. And that's actually the final profit. And if we pay the dividends, and that's the retained earnings for retained profit for the year. So that's actually the profit and loss account and income statement for the hypothetical year of the 31st August, because it should be of one period for the business. So we will do some calculation on the basis of income statements and Excel and the balance sheets. So that's the income statements. Let's see how the balance sheet is look like. So this we have seen in our presentation slides. That's income statements, sales, cost of sales, gross profit, operating profits, profit before tax, profit after tax, and retained profit. Statement of financial position or the balance sheet, it looks like assets and then capital and liabilities. Assets and liabilities, and the figure should be equal, both the sides. That's our statement of the financial position. And then we have non-current assets and the current assets. And we have a capital and the liabilities, non-current liabilities and non-current current liabilities. That's these liabilities and total capital figure should be equal with total assets. So that's the balance sheet of the firm. This looks like. Now, we need to analyze these income statements and financial position to get any decision, and then we will calculate the ratio. Basically, ratio is, we call it ratio, is this one, 2 dots. This sign is called ratio, and ratio is a mathematical expression relating one number to another and providing a relative comparison. Because in ratio we have two different types of figures, and then we compare and contrast two different accounts or two different heads for the ratio. And the ratios helps to link the financial statements together and offer figures that are comparable between different companies and across the industry and sectors. And it's very helpful, and it's a very core heart of the finance. So let's see what kinds of different ratio analyses are here. Okay. Before we start, we need to know, okay, what is the purpose of the ratio analysis? Basically, this is the benchmark of the financial strength and weaknesses. So if you understand the ratios, then we can understand the financial strength and weaknesses on the basis of the different stakeholders. For example, I want to invest in this company, so I want to see the financial statements in the published account, and then I can identify some ratios, and I can analyze the financial strengths and the weaknesses of the company. And then if you want to understand the financial position of this firm or a business and to analyze forecast, and then you want to do the budget trend compared to the history and competition, ratio analysis is very helpful. And how can we calculate the ratio analysis? The sources of the calculate ratio analysis is income statement. Which I have showed you what is the contents of the income statement, and then there is a typical balance sheet statement of the financial position, and then sometimes cash flow statements will also can make some measurements for the ratio analysis. There are some limitations in ratio analysis, which call, like, they are not following any accounting policies. So if the different companies follow the different accounting policies, so they're not following. There is no standard rules how you are going to calculate, because you are playing with the number from the income statements and the statement of the financial position. So it's like very individual judgment who are using which number and what is the purpose of using that ratio. And there's different kind of industry sectors and trade and year and date. So that's the one limitation. And then sometimes if you want to compare the company to the other company, depends on the size and the stages of the growth will be problematic. That's the one kind of limitations for the comparison and the contrasting the business size and company and stages of growth. So these are the main key management ratio I have taken. There are 5 different types of ratio in the heart of profitability, financial status, activity, employees, and investment ratio. So on your assignment, you need to put these all the ratios, and then I will show you how you are going to calculate this ratio from income statements and balance sheet. So profitability ratio actually measures the margin of different types of profit and income. So you can, because there is a different kind of profit: gross profit, operating profit, net profit, profit before tax, profit after tax. So this profitability ratio can measure the margin of different types of profit and income. Financial status ratios will say you the solvency position of your company. So it's actually ratio expresses the short-term solvency sometimes in the current ratio, and the asset test and quick ratio means how quick the company can pay off its short-term obligations. So current ratio and quick ratio is a very important ratio for the firm, and if you can calculate, then you can understand how the company are solvent and what is the position and how quick the company can pay off the short-term obligations. There is the activity ratio as well. Normally, the activity ratio means at the rate of which the company is turning over its assets and liabilities. If the company wants to see performance compared with its staffing level, employee and health and other things, so they can make this kind of activity and employees ratios. So basically, and the investing ratio, if you have a per share value, so you can measure the sorry, you can always measure the earning per share of the company. Sorry. So this financial status ratio, also called the liquidity ratios, which are some of the most widely used ratios, perhaps the next to the profitability ratio. They are especially important to the creditors, and this ratio measures a firm's ability to meet its short-term obligation, as I said before. Okay, let's see how these ratios can calculate. So on gross profit ratio, you can take the gross profit as we see in the income statement, and you can see the sales amount, and then if you take the gross profit divided by sales and multiply the 100, and the source of these figures are from income statement, and then we can measure this in a metric in percentage, so that 10%, 15%, 12%. So if you have a gross profit ratio like this year, previous year, and then you can forecast your next year gross profit, and you can estimate how much profit you need to earn, and then how much sales you need to do for the projected year. So these are the formula of the gross profit ratio: gross profit divided by sales, multiply 100. Net profit margin, sometimes it's called return on sales, because you are taking sales and then you are dividing operating profit by sales, and then you can get this information from the income statement. And when you multiply the 100, then you will get the percentage of the return on sales on net profit margin. Return on capital employed is very important. You can take sales divided by capital employed. That means if you have the total asset from the balance sheet and the current liability, multiply 100, because this figure you need to take from the balance sheet or statement of the financial position, and then these figures you can get from income statement. So you need to see both income statement and the balance sheet, and then you can get the result of the return on capital employed. Now we will see that examples to how to calculate the different kind of profits, ratios, and the other ratios. So this, when we get the results of the ratios, we need to interpret. So gross profit or gross margin ratio tells you to measure the production efficiency and reflect the pricing decision from the product costing. So the one of the very important thing, and this is an indicator of changes in buying prices of raw materials and different kind of overhead, selling prices of finished products and production efficiency. So you can measure the indication and you can assume the production efficiency by these figures and reflect the pricing decision from the product costing. Sometimes it's not always stable, so you need to calculate more periodically, and then no general yardstick as depends on industry. As it depends on the size, growth, and sector of the business. So it depends on your interpretation, how you focus on your ratio interpretation. And then if we get 30% of gross profit from the ratio calculation, then we can say that 70%, that means 100 minus 30 is equals 70. So if we get the 70% of gross profit, that tells us 70% revenues generated by the farm are used to pay for the cost of goods sold. So we have a cost of goods sold, that's a sales cost. So if you have the figure of here, then if you deduct from 100 this figure, then the remaining percentage of revenues generated by the farm are used to pay the cost of sales. Now, return on sales is a very important ratio. We take the operating profit as it is just after the overhead cost, the profit before interest and taxes or operating profit, divided by sales. That's called operating profit percentage, and then it's targeted. This is the benchmark, 10%, but depends on the type of industry, definitely. And then comparative is return on capital employed, a low return of sales. If we have the 18% of the operating return on capital employed, which suggests that for every £1 of revenues generated, 18 pence is left after deducting the cost of goods sold and operational expense. These are the interpretation. So you need to be very careful when you interpret your figure. And low industry return on sales indicator is overall the competition. So comparative to return on capital employed is, as the sales volume is high, that's different percentages will show you the different interpretation. So let's take a financial status or solvency ratio. So there's a current and quick ratio, or we can say the current and asset test ratio. So if you take the current asset and the current liabilities from balance sheet, then and that's compared with the 1, that's a benchmark. And if the result is a 2:1, if the result is 2:2 or close to 2, that's a standard metric. And then if you take the current asset test, which is current asset minus stock or inventory, liquid assets divided by current liability, or sometimes some people do current asset minus current liability divided by current liabilities. And then if it's close to 1, that's the standard. That means the farm is solvent to pay its short-term obligation. And then if it meets the standard, like should be about the 1.6 to 2.1, the currency ratio measures short-term solvency. That means adequate short-term assets towards short-term liabilities. And if it is very high, sometimes it's more than the 2, that means there is a company may have current assets but inefficient to use this asset. And then I say that the current liquid assets is divided by current liabilities is the asset test ratio or the quick ratio. So you can measure both the ways. You can take the current asset and then you deduct the inventory stock and then you divide it by current liabilities, or you can take current asset minus current liability divided by current liabilities. So it's very important and critical than the current ratio, because this is the asset test ratio, and it should be 6.6 to 1, and shows the ability to meet very short-term obligations that creditors out of short-term money in the bank or due in. Sometimes the supermarket, the big turnover business may have a very low ratio, say 0.4, which is standard is 6.6 to 1, but it compensates by a high stock of turnover and little or no credit giving. Now we can take some efficiency ratios with the activity. We can take this in days, inventory and stock days. So you can take the stock divided by cost of sales. When you take the inventory, we always take the cost of sales. When we take the dates, we will take the sales, and then we multiply the 365, this is the year, and then we can interpret it in terms of days. And have a trade creditors ratio also, creditor ratio, that's the payable days, that's the receivable days, that's the stock days. And then we multiply 365, and then that's the cost of sales or all kind of purchases, and then we can measure the activity or efficiency of the firm. Employee, we can take the employee number from the HR department, and then sales per employee, we can estimate then the amount per employee, and then we can also estimate or measure the operating profit per employee. So these figures we can get from the HR or other notes. So we can see for the employee ratios, the purely simply indicators to look deeper or staffing levels with financial performance. And then we can have another investment strategic investor ratio, that's earning after tax divided by number of shares issued. That's the EPS, earning per share, and then just not that much easily comparable between companies. If that would be the stock exchange market, the secondary market, capital market listed company, and then this EPS should show the growth year of the year, on the year or different year, and mainly applicable to the public companies. Okay, and then metric is like pence per share, so one can, or any stakeholders can easily calculate the EPS, and then what's the pence per share, earning per share, then can easily calculate. So let's see one examples how we are going to calculate these ratios. So these income statements I showed you in my presentation, and these are the balance sheets, assets and liabilities. Now we are going to show how we are going to calculate gross profit margin, net profit margin, current ratio, quick ratio, activity ratio, stock days, creditor days, dated days, and also per employee ratio, sales and profit, and earning per share. So let's say this is our income statement as at 31st August. So we can compare this figure with the next year, 2017. So if you calculate this kind of ratios, then we can interpret these results on the basis of the performance, short-term obligations, efficiency, and employees, and the capital market earning per share. So gross profit market, as we say, seen that the calculation is gross profit divided by sales. So this is the Excel sheet. You can calculate the figure directly in Excel, or you can use the calculator, because you are taking the figures from the public accounts, and then that's the published accounts. You can go to online, any kind of company, and then if you click on income statements of Sainsbury, then they will show you the annual report. So what you can do, you can search the annual report of any of your selected company, and then you search the relevant income statements and then statements of financial position. So if it is gross profit margin, then in Excel sheet, we will take the equal sign. The equal sign. So this is gross profit divided by sales. So gross profit is this figure 960,000. So take that color, take that box divided by sales. If you click that one, that will give you the gross profit margin. And because this is 100%, then it is 30%. If it is multiply 100, because we need to show the metric in percentage, then it will show you the 30%. So that's the 30%. The net profit margin is equal operating profit divided by sales. So you should start with your calculation with the equal sign and then take the operating profit, that's your operating profit, that figure divided by your sales. And that's 0.128, so that we can take 13%. Okay. So current assets divided by current liabilities is your current ratio. So current ratio. So this calculation, this formula are in presentation slides, so you can take, and then I'm going to upload these statements in your Moodle area so that you can also see this formula. So current ratio is equal current assets. So this figure you need to take the balance sheet. So current asset, this is our current assets and this is our total figure divided by our current liabilities. So this is our current liabilities, and then you are taking the current liabilities from here. So that's 0.88:1. So that's 0.89. We can take it's like 0.89. Sorry, I think it's 0.9. And then our quick ratio equals current assets, because we need to take the current assets, that's our current assets, minus our stock here. Because we are dividing current liabilities of this figure, so we need to take a bracket. Otherwise, it will divide only the stock. So take the bracket, that's a BODMAS formula, and then current liabilities. You can do also this by your own calculator. You don't need to do with your Excel sheet because on your assignment. So you can use your calculator and input the figure. So here is 0.330. Now the interpretation. This is good because our current ratio is 2:1, but it's not as close to 2. And the quick ratio is 0.6:1, and it's less than 1. That's the firm is not sufficient to pay its current obligations or short-term obligations. So it's not having enough liquid assets in the firm. That's the interpretation. Stock days, debtor ratios, creditor ratios. Stock. This is our stock equals divided by cost of goods sold, this one, and then we have to make first bracket because of the BODMAS formula, and then we need to divide it by sales, cost of sales, and then we take we need to multiply this with because we are calculating the days, so that's a 32.58, so we can make it 33 days. It depends because days couldn't be fractions, so we can make it 33. This should be the 33 days. Debtors days equals, so debtors, these figures, divided by sales. This is our sales, and then we put the first bracket, and then we multiply with the 365. So that's the 11 days. So on the days, you have to put the days here, 32 days and then 11 days. On your creditor's days or creditor ratio, you can take, because we are taking the first bracket, sorry, creditor. So here you see where is the creditor. These are the creditors. So take that creditor divided by cost of sales, this figure, and then you multiply days 365. So stock days is 32 days, debtor days is 11 days, and the creditor days is 24 days. And then normally we offer 30 days for the creditor, and then days, and then stock days. That means how many days our stocks are held in the company, and then how many days you're expecting your receivables from the debtors, and then how many days you can pay your credit to your suppliers. So these are the days you can calculate from the formula. Now we want to see the sales per employee and the profit per employee. Here you can see the there is information, number of employees of this company is 12. So we can take this directly. So sales divided by our number of employees, that's our 26,000, that's the sales per employee, 26,666, so 67. And then operating profit per employee, that's mean after overhead expense. So we have got operating profit divided by our employee. That's 2,417 pounds. So we can make it a round figure, 3417, and then sorry, if you click equal, that it requires a formula. Other way you can do it like, so if you reduce the decimal figure, so you can reduce the decimal figure, it will come this way. So 3417, so it will come, if you reduce the decimal figure, look, then it will come this way. Now, profit after tax divided by number of shares is your earning per share. So where you can get the number of share issued. If you see your capital and liabilities, then you can see there is a figure 20p, and then number of share each 250,000 shares. So these are the number of shares, and then how can you calculate the earning per share? So if you take, I'm going to calculate this ratio here, so I need to start with the equal sign, and then profit after tax is here, and that's the 23,000. If you click that box, that will come the column reference, and then you divide it by number of shares. So number of shares is 250,000, so you can write down straight over here 250 and then 1,000. So that is showing the pence. So that means 9.2 pence is your earning per share. You have to write this way. Now the question is, these figures tells nothing because this is a number. You need to interpret these figures to your users. For example, if you take the current ratio and quick ratio, these are the, I've showed you the benchmark of the current ratio and quick ratio. The current ratio benchmark is 1.622:1. So this should always be examined in conjunction with the sit test and the guide to 1.6 to 2:1. But industry norms need examining. So, but here we can see the current ratio is lower than our benchmark, and then quick ratio is lower than our benchmark. That means this company doesn't have any sufficient liquid asset to pay its short-term obligation. There is in profit margin, there is no benchmark, but normally in the net profit margin, we generally look the 10%. 10% is good for the farm. So here is a 13%, which is beyond the 10%. That is good. And this means how many days you are taking to pay your creditor and how many days you are waiting for the receivables. And this is good. Normally, we actually range it to 60 days, 2 months time, but it's lower than the 2 months times. And the less the stock held in your company inventory, that's good, because here the one you're holding your stocks more than a month, that 32 days. So that you need to explain in your report on the basis of the ratio calculation. So I'm going to upload these statements, this Excel sheet in your Moodle area, so that you can check the income statements and balance sheet, how you are going to calculate. But on your assignment, you are not going to calculate this figure. You need to download one of the public accounts. You can get it from annual report. Any big company's annual report, you can get the public accounts, income statements, and the statements of the financial position. So you download that company accounts, and you need to compare the different kinds of ratios. So you can take these ratios on your assignments so that you can prepare your assignments. So I can show you at a glance. So these ratios you need to produce in your assignments. So these are the ratios you need to show your assignments: profitability margin ratio, financial status ratio, activities ratio, employees ratio, and investment ratio. And then you calculate all the ratios, and then need to interpret the ratios in the proper way. And then you have to interpret in the figure in terms of industry, if possible. If you want to get a good marks, then it will be good performance on your assignments. So these are the 5 key ratios you need to put in your assignments. So as on your assignment, you have to do the 4 different tasks, as I said, and then you need to understand the learning outcomes, and you have to meet the standards which is specified by the assessment criteria for the unit. So if you go to your Moodle here, you can see your assignment briefing and your activities. So you have 3 activities you need to do, and you have to download 1 company account from the public account, and you need to do the calculation on each. So you have 3 activity, and which is we call typically task 1, 2, and 3, and then you must visit some publish account, as I said. And then on your activity 3, you have to produce, because you are making a handbook and report, and then you must understand the structure and purpose of the company accounts. And you can take these examples from this presentation and the lecture slides. And then you must obtain a set of published accounts from a large sector company. And then you can do this by accessing the annual report and accounts on their website and calling or writing. If you need any help, you can email me, then I can help to how to get a business or request a copy. And then from that annual account and reports, you have to obtain as an example and describe the main financial statements. So what kind of financial statements you are discussing on your handbook and then produced by the company and explain their structure and purpose. So there is a little brief explanation you need to produce. And then you can analyze those accounts using a range of ratios. That's the 5 different kinds of ratios I showed you and the calculation. And you can support your answer. That's the numbers from the annual report, and then you have to interpret that ratios in your own language. We are expecting in your report or handout the assignments, your analysis must include a review of the company's financial and business performance during the year and compared with the previous year. Okay. On your annual reports, you can get 3 years annual data, so previous year, this year, and then previous 3 years. I would say that you have to do the 3 years calculation. So you can make 3 columns, and then you can make a ratio analysis for each 3 different years. And you should also identify any factors that may affect the business in the coming year. So there's you are making a report to your stakeholders, what is the current position of your company based on the ratio analysis, and then what is the previous year's position, and if there are any suggestion or any kind of obligations you have observed, you can express in your handout and annual report. And if you make a draft submission, like your finance for administrative managers, because you need to produce minimum 15 to 20 pages explanation on the basis of 3 different activities. So this is all actually the mathematical expression and some workings on this activity. So you have to play with the number. So I'm giving you 2 weeks time so you can submit your first draft, and then I can have a look, and then I'll give you formative feedback. And then final submission will be the end of this month, and then that will be judge your grade. So these are so far the 3 learning outcomes. So first lesson we have showed you to understand the relationship between the cost accounting and the management accounting, and you need to explain the purpose and scope of the cost and management accounting. That's the first activity. And you need to analyze some information provided by a cost accounting system which supports the decision taking. And then on second, third sessions, you can see that we showed you how budgets and budgetary techniques can be used, plan and control finance. And then you need to explain the relationship between the budgets. You need to explain how the budgetary techniques can be used to plan and control finance. If you follow the lectures, recording lectures, and then you can understand with the presentation slides how you can make up your handout on the basis of the report, assignment report. And this session is basically you need to explain the structure and the purpose of the main financial statements, which is the learning outcome 3, understand the structure and purpose of company accounts. So when you produce an annual assignments report, you need to check your learning outcomes because we always based on our learning outcomes to produce our presentations and then assessment criteria, because we want to see the learner can understand and explain what we are trying to tell on the basis of the learning outcomes. This session we tried to explain the structure and purpose of the main financial statement, and then we showed how you analyze the company accounts on the basis of the income statements and then statements of financial position or the balance sheet. So this is the end of the session today, and also the end of the unit lectures. So far I have delivered 4 lectures, and then which are recorded, which are available in the Moodle area, so you can get the access, and then you can listen my presentations and everything. First handout report of draft submission deadline within the next 2 weeks. That means within the 14th. Well, today 30. So we have to submit within the 2 weeks time. Then if you have any problem and queries, you can just email me or you can call me to our office number. And then after 2 weeks time, you need to submit your final submission end of this month. So this is the end of the sessions, and then this unit explores basically financial information administrative managers, because the course is finance for the administrative managers, and then explores how you analyze different kinds of accounts and the financial information for the administrative purpose, and then also the administrative managers to plan, control, making any decision, making effective decisions. And also for this from this course, anybody can aspire to managerial positions in businesses, or will develop the fundamental financials and accounting knowledge and understanding and skills and understanding such jobs roles. Well, this is a very, very important unit module, finance for administrative manager, and that knowledge of the cost accounting and management accounting, budgets and budgetary techniques, and the structure and purpose of the company accounts and the ratio analysis. These are the core hearts of finance, and you can understand all of these from the presentation slides. If you go for the assignment briefing, that's a sample assignment, then you can read all the activities, and then you can play with the numbers, and then you can follow the lecture slides as we have showed in this figure, and the presentation slides. To achieve these units, learners must achieve their learning outcomes and meet the standards. Otherwise, we can't give you any feedback or the pass marks. And then there are some also additional assessment guidance is here in the website, and it's very important for you who wish to become managers, as it provides knowledge of financial and accounting information which is directly relevant to this role. Because a manager needs to understand the financial structure, financial performance and everything, because the business is based on the finance, because all the business are targeting the profits and then different type of profit mechanism. So you can apply your knowledge, this kind of knowledge and understandings, by analyzing the different kind of financial statements of an actual company. And then therefore you need to access the copies of annual reports and the accounts for this analysis, and then you can analyze your own company where you are working on it. So these are the Finance for Administrative Managers course, and if you have any query, this is my email address, and my name is Ronnie, Nahid Ronnie, so you can email me, drronnie@university.co.uk, and then also you can call to our office number. You have our University office number 0161, and then you can check the number. Monday to Friday I'm available from 10 to 4 in the office, and we can have a talk if you have any queries or any kind of clarifications on your lectures or any kind of understanding, because this is a very much mathematical course, and then you need to have some practice on different kind of activities, because this is a very interesting course. And then cost accounting, management accounting concepts, and different kind of budgets, so like in our activities in the cash budget and the ratio analysis, very interesting topic and very important topic. And you will need to explain the ratio analysis results on your on your assignment report. So hope for the best. And also I advise one good book if you want to get a better understanding for the financial analysis. Go for that book, Richard Baker's book. Also there is some sample suggestions in the Moodle area. You can have some online resources and sample book. So if you have any query, please call me to our office number, or you can drop me an email, and then I can get back to you soon. Thank you very much, and enjoy the Finance for Administrative Managers course. Bye.